What if there was an encrypted message that you just couldn't figure out and it posed massive danger to you? Well, that's sort of what the financial markets are. But there was a phenomenon that happened, a synchronization event that broke this open and allows us to peek inside the markets and predict with an uncanny ability to know exactly what's going to happen next. And if you use this tool correctly, you can make more money than you imagined over the next 12 to 15 months. So in this video, I'm going to break down what these cycles are, how they got started, and how each wave gets bigger and bigger. We're going to talk about this phenomenon, the synchronization event that put them all in the same order. And then we're going to look at how they break down over what time frames and exactly how we can use this information to make money on the way up or down depending on what part of the synchronization cycle that we're on. This is an amazing phenomenon. It's the first time I've talked about it here. You can't wait to see this, so let's go ahead and just jump right in. All right, welcome to the channel if you're new. My name is Mark Moss, and I make these videos to help break down these complex subjects of the markets and how they move in the movements so you don't get caught in the same situation I did back in 2008 when I was focused on my business and I was focused on my real estate developments and I wasn't focusing on the markets. I wasn't focused on the macroeconomic environment. Unfortunately for me, it caught me off sides and cost me everything. So I've spent the last 12 to 14 years understanding these cycles and how they move so I don't get caught offsides again, and I don't want you to either. Now, I've talked a lot about how something changed in 2008 and how most people, when they talk about the market, 1970, the 2000, 1970, 1940s, etc., that it's all wrong because something changed in 2008. So I've been talking about this for a while, but it wasn't until recently that we cracked the code on this. This is the first time that we've talked about this publicly. I'm talking about what I'm calling the Codex, the monetary Codex. The Codex is basically a cipher, a way to decipher an encrypted message. And that's exactly what this is. It's a way to decipher, to unencrypt the movements of the market so we can have a lot more success into it. All right, so let's go ahead and jump in. I want to break this down, and we're going to use this to do something that's impossible. And I'm talking about timing. And more importantly, we're going to time the cycle. So we're not timing the markets. I'm not going to tell you the exact time to buy something or exact time to sell something. As a matter of fact, nobody can. Anyone who tells you they can, they're lying. They can't do that. We don't know the top or the bottom until we're looking backwards. However, what we can do is we can understand the cycles. We can time the cycles and we can know what phase we're in and what assets we should be invested into and should we be long, short, etc. So that's what we want to break down. That's all you have to get right. But first, before we jump into exactly how to do that, let's talk about how these got built up. Now, before I talk about how these cycles got built, and then we'll talk about, like I said, how to map these out and understand the time frames of these, I do want to let you know that there's a lot more to this, how this actually works, the individual assets you want to buy at the 4 phases of the cycle, and specifically which assets to be in right now for the next 12 months. It's more than I can cover in this short video, but I'd love to have you join me next week. I'm having a live presentation. I have about 30, 35 charts to show you so you can understand this. And then I'm going to take all your questions live so you know how to implement this information right away. You don't want to miss this. If you want to make a lot of money over the next 12 to 15 months, you need to understand this last part of the cycle. Before we go and do quad 4, there's a link down below. It's free, QR code on the screen. Just come hang out with me. It's fun. We hang out. I'll answer all your questions live. Okay, now how did this cycle get picked up? The first thing you have to understand is that we are in a debt-based monetary system. It used to be a gold-based system, an equity-based system, 1971 officially, started earlier, 1913 probably, but officially we are in a debt-based monetary system. So that means that money is created through debt issuance. And the thing with that is that the debt has to always continue to grow. And because the debt always has to continue to grow, because the debt is now collateral for more debt. So if the asset prices go down, that means the collateral goes down. And if you've ever done options trading or leverage shorts, whatever, you understand that when the collateral goes down, you either have to post more collateral or you lose the position. And so that's basically what the whole world is in. And so we can't allow the collateral, the assets to go down because it's collateral for more. And so the debt always has to expand. And we can see this is just since 2014. And this is the amount of debt around the world, the global debt, well over $300 trillion of debt, which is just amazing. Now we can see during the pandemic, we increased that, but it's just been a steady grind higher. Now I've covered in a previous video, I don't want to go deep into, but part of the reason why this debt can never be repaid back, besides the fact that we're in a debt-based monetary system, is that for about $320 trillion of debt, there's only about $80 trillion of dollars to pay off the debt, which is a big problem. But this is what leads to these cycles, these debt cycles, if you will, something I talk quite about. Now, we understand also that the debt has to continue to grow because it's a function of a debt-based monetary system, but it's more than that. Here we have a chart of the real GDP, the gross domestic product of the United States. And what we can see is that while it goes up and down, we can see that it's trending down. So the GDP, the economic growth of the United States, and the world for that matter, well, let's just focus on the United States, is trending down right now. And what we can see is that at the same time, we can see that the U.S. working age population, so working age, able-bodied people aged 15 to 64, we can see on a 5-year, year-over-year split, while it does go up and down, we can see that the trend is also going down. So as the working population is going down, less people to work, less jobs, less economic growth, we can see that mapped out in the GDP. All right? So as that's happening, then what we can see at the same time, what's also feeding this is we're seeing a plunge in the U.S. birth rates. And again, nothing ever goes up or down in a straight line, so the birth rates don't either. But what we can see is that the trend is down. This is U.S. birth rates per 1,000 people. Now, what we also see, of course, if we have less people and we have less working age people, then the U.S. labor force participation rate is also going down. And we can see that the labor force participation rate and the birth rates are basically in sync right here. And they're all going down. And again, we have less births, we have less people, we have less people, we have less people working, we have less people working, we have less economic productivity, and then less economic productivity, then GDP is also going down. Now this is the labor force participation rate we already looked at, and in green, the U.S. government debt as a percentage of GDP. And this is where it starts to get interesting. You can see that these are mapped out almost perfectly. Now, the government debt as a percentage of GDP has been inverted, right? Because obviously the debt has been going up. So what we did is we inverted those so you could see how correlated the labor force participation rate and the government debt to GDP is. So the GDP is going down with the birth rates and labor force participation rate, and so the government debt has to go up in order to fill in the gap. Okay, now we can see the Fed net liquidity, so again, like the Fed balance sheet, we can see it going up, and the U.S. government debt as a percentage of GDP is also going up. Of course, as the Fed's balance sheet grows, the government debt goes up, and as a percentage of GDP, it goes up because the GDP is going down. Does that make sense? So we have to understand debt first because debt is what's causing this all to happen, and then we'll learn how to map that out. Now, I talk about this quite often through these cycles. You might have seen any one of my videos where I'm breaking down these 250-year cycles or the 80-year financial cycles, the 50-year tech cycles. So you know I love my cycles. But what I want to show you, this is basically a cycle where we can map out the growth. Now, this is a total global liquidity, not the United States, but total global liquidity. So that's all the money at the central bank balance sheets, that's available credit, lots of things like that. And what we can see is that the global liquidity, the amount of money that's created in credit and debt, et cetera, that's expanding around the world, has these seasons. And we sort of have 3 years up, and then we have 1 year down. And then we have 3 years up and 1 year down, and then 3 years up and 1 year down. Now, let's say you're an elementary kid. You're pretty good at understanding patterns. What do you think happens from here? Do you think we might have 3 years up and 1 year down next? Are you starting to see that? All right, we'll come back to that in a minute. But there's this very, very interesting phenomenon, as a matter of fact. If you know what these things are, this is a metronome. And a metronome helps you keep perfect time when you're playing a musical instrument, piano, guitar, violin, whatever it is. The interesting phenomenon about this is that a metronome is supposed to keep perfect time. But if I get a group of metronomes and put them onto a table, and I start them all different times, so they're all in different beats, within a short period of time, depending on how many there are and what surface they're on, within a short period of time, they'll all get into perfect synchronization. which is an amazing phenomenon because, again, they're supposed to keep perfect time. So how do they all get from different time, different beats, onto the same? But understand that phenomenon is more than I need to break down right now, but this is the same phenomenon that's happening in the markets. Let me explain what I'm talking about. What we saw back to 2008, as I explained, is that something changed in the world. And again, I haven't been able to figure this out for a while until this finally kind of made sense to me. So we're in this debt-based monetary system. The debt has to continue to grow. So that means that debt doesn't get paid, it gets refinanced. It's the old, kicking the can down the road, so to speak. Now the thing is, in order to refinance the debt, we have to issue more debt. That's why the debt continues to grow. So all these different debt cycles, different governments, different central banks, different corporations, everyone has debt, but different terms, 1 year, 2 year, 5 year, 10 year, 30 year, et cetera, all taken out at different times. So all this debt around the world, the $320 trillion, that's been growing, is all getting kicked down the road, all getting refinanced at different rates. But then something happened. That's sort of like all the metronomes on different beats. But then in 2008, what changed is that when the great financial crash happened, the whole world brought rates to zero at one time. Now, if you own a house and you have a mortgage that's locked in right now, let's say that you bought it in the last year, you have a mortgage rate of, let's say, 7%. If the bank decided to lower the interest rates to zero, would you refinance your house from 7 to 0? And of course, the answer is yes, you would. And that's exactly what happened. So when the whole world in 2008 brought rates down to zero, what do you think everybody did? Businesses, governments, central banks, etc. Well, they all refinanced their debt. Now, not all of them, but the majority of them. What we can see right here is just the maturity distribution of interest-bearing public debt as a percentage. And what we can see, here's about a year, and here's 1 to 5 years. So what we can see is about 75% of all public held debt is within a 5-year period, a maturity distribution, meaning all this debt has to be refinanced in about a 5-year cycle. Now, it's not all exactly 5 years or 4 years or 3 years. There's an average. So the average is somewhere around 4 years. 75% of the debt has about a 4-year maturity distribution, and that has to get rolled over every 4 years. So just like these metronomes that had all these different syncs going on, they all got linked up together. Now, the interesting thing about that is it's not just all of this debt, which is obviously enough, but we can see is that also changed the business cycle. Of course, businesses, corporations, they all use debt as well. This is a chart of the ISM. It's like it shows the business cycle. And what we can see is this is working on 4-year cycles as well. So now we have the debt cycle, the global debt cycle, rolling over every 4 years. We have the business cycle rolling over every 4 years. We can see this is the U.S. liquidity cycle, and is again moving over in every 4 years. Now, why is that? Well, the reason why the liquidity cycle moves every 4 years is because every 4 years the debt has to be refinanced, and we have to issue more debt in order to roll over the existing debt. So everything has become synchronized. And what we can see looking at the Global Liquidity Index is almost every one of our financial crises has come at the bottom of this liquidity index. Now, going back to this chart, we looked at this chart of the global liquidity before, and I showed you sort of the rainbow pattern, the 3 good years, the 1 bad year. And now I've mapped it out for you with actual time frames so you can see this. So we can see from May 2010 to June 2014, 4 years up, and then look at this, a whole red down. Then we have March 2015 to March 2018, and then down. October 2018 to March 22, up, and then down. Now, this just so happens to coincide with when the Federal Reserve, and thereby all the other central banks around the world, said they were going to start tightening markets. If you remember that, inflation was transitory, it's not a problem, we're going to let the inflation run hot. Finally, around, I think it was November of 2021, the central bank, the Federal Reserve, put out a notice that we are going to start quantitative tightening, QT, start tightening the markets. When that happened, what do you think happened to liquidity? It started going down. Now, in October of 2022, that changed. And if you have been watching my channel for any amount of time, you know in October of 2022, I made a video. And I said, there is no market crash coming, and here's why. And I've gone on to make a series of videos throughout January 23, hey, it's time to buy. March 2023, I'm back in. And I made all those videos, not because I had a crystal ball, but because I was watching this liquidity cycle that went back up. I just didn't understand the timing of it yet, which is what we're going to talk about. But you can see how this is starting to work. Now, going back to this chart, again, I added some arrows so you can see this a little bit better. But we have the 4 good years and then the 1 down year, the 4 good years and the 1 down year, the 4 good years and down year. Now, for all of you guys that like to look at your portfolio on a daily or weekly or monthly basis, as I say, you're never going to make it, but a little bit of hope for you here. Nothing ever moves up or down in a straight line. Okay? And this is why when I opened up the video, I said, it's not about timing the markets, it's about timing the cycles, right? So we don't know the top, we don't know the bottom till we're looking back on it. What we do understand is the cycle that we're in, and as we say in the investing world, the trend is your friend. We just want to be in the trend. And so we know that as liquidity started coming back on here, if we let it ride, as we say in the gambling world, if we let it ride, we would do very, very well, right? The problem is if you were looking at your portfolio on a micro basis, like, oh my gosh, I'm making money. Oh, I'm losing. Oh, I'm making money. Oh, I'm losing. Oh, look how much I made. Oh, I lost. Oh, I made money. Oh, I lost, right? And you're going back and forth and you can't do that. So we want to understand the cycle that we're in, and we want to just ride this thing all the way up. And then we either want to get out of the market here, or we can flip short and make money on the way back down, and then we can make it back up again. Now, this, as I said, was about October of 22 when I started making videos about time to go back in the market. And again, if we were just to stay long, we'll probably end up somewhere along here. Now, it's going to be like this, and then it's going to be like this, and it's going to come down, right? It's going to be like that. But this is the cycle and how it's working. Okay, now the next question you might ask yourself then is, well, if all this debt is getting bigger and bigger and bigger, and is rolling over, and that's what's pushing up asset prices, then how much more will this debt grow? How much is it projected to grow? And the good thing is that, well, the government tells us that. And so we can go directly to the U.S. government's CBO, Congressional Budget Office, and they publish this data. As a matter of fact, the new 2024 report just came out. And what we can see is the U.S. public debt increases are projected, as you can see, to absolutely skyrocket and blow up. And of course they will, because they have to. We already broke that down. A debt-based monetary system. They have to issue more debt to roll it over. In addition, they have to make up for the low birth rates that we're having, and low birth rates equal low workforce participation rate, which means GDP goes down, which means more and more debt is continued to be put into the system to keep this cycle going. By 2034, they expect it to be about 116% debt to GDP, which is a wrong number because we're already higher than that. So whatever they show you here, just imagine that will probably be up to there by then. And that means these liquidity cycles will continue to get bigger and bigger and bigger. Now, the next thing that you need to understand is that in these cycles, there's technically 4 different parts of this cycle. So for example, as the cycle goes up and down like this, we have what you might call a spring, summer, winter, fall cycle to that. And we would want to have different types of assets in each one of these cycles. And this sort of breaks this down for us right here. So the rebound as it's coming back up, the calm before the top, the mania, the speculation, and then the turbulence at the bottom, and the different types of assets that we'd want to be in each part of those cycles. Now, if you want me to break this down in much greater detail and actually tell you, this is just asset categories, so it's like equities, credits, commodities, etc. If I'm going to break this down and tell you what assets in each one, then you probably want to come hang out with me live next week, because this is a whole nother topic. I got like about 20, 30 charts. I'm going to break all this down for you, and then I'm going to take all your questions live, so you can ask me any questions that you have about this and how to implement it. Highly recommend you come hang out with me. And it's just good fun. There's a link in the description down below. It's free if you want to come hang out. There's a QR code on the screen. Scan that. Highly recommend you come, because the next 12 to 15 months is going to be nuts. Okay, now the next thing that we have to understand is that as these debt cycles, as these liquidity cycles continue to roll over and continue to get bigger, as we see here, they move asset prices differently. So for example, this is a zoomed in picture. Again, this is going back to October of 22, and we've been on this upward liquidity. Now, as I said, nothing goes up in a straight line, so we've certainly had our peaks and valleys here at the top, and then it continued higher. So some people might have gotten faked out. But also, like I said, nothing even goes down in a straight line either, right? So we have to understand that. What we want to be is, again, directionally right. The trend is your friend. Now, this is a chart of Bitcoin. The reason why I like to use Bitcoin here is because Bitcoin is the most sensitive asset to this liquidity. And what we can see, this is the same time frame, October of 22, and we can see it's taking off at the same time the global liquidities, like literally in the exact same peak and valley. When the Fed announced they're going to start quantitative tightening, Bitcoin started selling off almost immediately. The NASDAQ, the tech stocks, started selling off about a week later. They're also very sensitive, about a week later. The S&P 500 was a few months later. So that's sort of how this works. Now, like I said, Bitcoin is the most sensitive asset, which is why I like to use this here. When we talk about sensitivity, let me just give you a couple of specifics here. So this is an increase in global liquidity. And we know that different assets have different sensitivity ratios. So for example, the S&P 500 is 90% correlated with this. What does that mean? It means it moves basically in lockstep. So what does that really mean? What it really means is that the S&P 500 is moving up at the rate of the increase of global liquidity. What does that mean? Well, that means as the global liquidity, as they print more money, the existing money is worth less. The value comes down. So as the value comes down, asset prices go up, right? Because it takes more money to buy those assets now. So it goes like this. And so what that means is the S&P 500 is sort of like a perfect proxy for inflation, meaning it's keeping up with the rate of inflation or debasement, not the CPI the government tells you, but the official monetary debasement. So you're not really getting ahead of the S&P 500. However, Bitcoin has a 8.95 times sensitivity ratio. Gold has a 1.49 sensitivity ratio. So what does that mean? That means gold moves up about 1.5 times at the rate of global liquidity. So for every 10% increase in global liquidity, the S&P 500 stays even. For every 10% increase in liquidity, gold goes up about 15%, pretty good. For every 10% rise in global liquidity, Bitcoin over here goes up about 90%. So not all assets are the same. We definitely want to be in the fastest boat or the most sensitive asset. Now going back to these repeating cycles, and this is where it just starts to get pretty interesting. Again, if we look over a long period of time, we can see that the ISM is following, this is the business cycle, is following these 4-year cycles. Now it's interesting, this is Bitcoin's 4-year cycles as well. This 4-year cycle, as the whole world, the phenomenon, the synchronization phenomenon that happened right at 2008, the whole world refinanced on a 4-year cycle, just happens to coincide and overlap with the 4-year presidential election cycle. And just so happens to overlap with the 4-year Bitcoin halving cycle. And so every 4 years, the new supply of Bitcoin gets cut in half, which causes Bitcoin to also move on these 4-year cycles, 1 down year, 3 good years, 1 down year, 3 good years. And we can see this right here. So here's 2011, Bitcoin popped, came down, and then went back to the moon. We saw 2014, Bitcoin popped, went down, and went back up to the moon. 2019, it popped, went down, went back to the moon. And now, here we are, right here. And we can see it popped, it came down, and now it's rebounded and it's about back to its all-time high. Now again, if you're an elementary kid, you know anything about patterns, what do you think if this happened, this happened, this happened, and now we're here, what do you think happens next? Well, my guess is that it probably goes up like that to match the rest of the pattern, at least for the next 12 to 15 months until, well, then the entire cycle changes. All right, so to summarize, I know we covered a lot of ground here. We're in a debt-based monetary system. The debt has to always continue to grow. It can't be paid off. There's not enough US dollars. Plus, because that debt is collateral, it has to continue to grow. It can't go down. So the debt must grow. We know that refinancing, we kick the can down the road, we have to issue more debt to pay off the previous debt, so it gets bigger and bigger and bigger. We know that in 2008, it created a phenomenon that put the global debt refinance cycle in synchronization, created this global sync. We know that these global synchronized cycles move in like a 3-to-1 ratio. I showed you those time frames. We know that there's different types of assets to buy in these different cycles. We'll get to more of that later if you come join me live next week. We know that the government, the CBO, Congressional Budget Office, projects the debt and assets to continue to grow at an astronomical rate. And again, we know that there's different asset sensitivities. So the S&P 500 is moving up perfectly with it. Gold moves up at a faster rate. Bitcoin moves up even faster rate. And there's other assets that move up at different synchronization rates and different sensitivity rates. So anyway, that's a lot of ground. It's a very interesting phenomenon, something that I've been digging into a lot in about the last couple months, and I'm going to continue to dig in more. So let me know what your comments are down below so I can make some more videos to support you as you learn how to use this tool to map these liquidity flows, well, to make as much money as you can. All right, give me a thumbs up if you like the video. If you don't, you can give me a thumbs down. That's okay, but at least tell me why in the comments down below. Subscribe if you're not already subscribed because you don't want to miss updates on this. And that's what I got. To your success. I'm out.